Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of welcoming Scott Price with Bonvolo Real Estate Investments. Welcome to the show, Scott.
Hey, thank you, Sakar. I'm happy to be here.
Thank you. Thank you for being on the show. Scott is one of the very intelligent investors, who, as I call him, took a lot of chances throughout his life, took care of a lot of opportunities, got into single family, multifamily, retail, land, medical buildings. Boy, the list goes on and on. Scott, along with his wife, Karen, they manage a large portfolio in Washington State, east and west of it. Welcome to the show, Scott. Give us an idea of how you got started, how everything came about for you.
Sure. Going way back, I researched how people in the world made money. And what I mean by that is, how people developed significant income and significant net worth. And there are always, the few people in the world who are famous for making money for some random ideas. But one thing I noticed that was consistent is, even though they might not be household names, there was a consistent number of people who made significant wealth off of real estate, and that really stuck with me. Mm-hmm. And so just started the path of educating myself and seeing what it took to get started in real estate and launched from there.
Right. Awesome. And you're absolutely right, Scott, there is that there are just so many millionaires. A large part of their wealth is housed within real estate, maybe different sectors within it. But always, let's say if someone's making money through their industry, their business or technology and things like that, but real estate plays such a large role into their portfolio of things that, and it cannot be ignored. The benefits and things like that cannot be ignored. So how did you get started there, Scott? Like, I know you started with single family and things like that. What was your first investment like?
Sure. Well, my first investment was what I would call a learning experience. And what I mean by that was I actually bought a condo right out of college that I was going to live in. And then a couple of years later, I moved into a house and I kept the condo. So that was my first rental property. Mm-hmm. And I managed it myself. And I had a great experience the first year, great tenants. They moved out. Had another set of tenants, didn't work out so good. They were not good people to work with. And it was such a bad experience for me. I just wasn't used to it. I wasn't accustomed to dealing with that and dealing with people who might lie and make up reasons for why the rent isn't coming in and things like that.
Sure.
That I sold it. Actually, I said, oh, this isn't for me. And I got into stocks and day trading and all this kind of stuff. But real estate kept drawing me back that it made sense. It was the way to be able to grow. It's understandable, unlike something like stocks, which you really have no control over.
Sure.
You can control it. If you put a lot of time, effort, and knowledge into it, especially to get started, it's something that can snowball over time. And sure. if you ride the inflation train and ride the time machine of how wealth can just compound over time, then real estate can be a very understandable way to develop net worth. So I got back into it even after that. And the main learning for me was in those kind of cases, especially for residential, that I now have a model where I outsource my property management to whoever is the best local property management company. And when I have triple net properties that are commercial, I'll manage those myself because they're so easy. But
Sure.
if it's residential, even if it's nearby, just for my model. It's fine if other people want to manage it themselves, but for my model, I actually, use other property managers. So anyhow, I learned from that experience. I knew my one mistake was it would help me to have a property manager. And then I actually got to the point of saying, okay, well, how am I going to immerse myself in this world? And what I did was I said, well, the best way to do it is go full time and make it my income. And I couldn't make my income off of an investment because I didn't have any. So I went into real estate brokerage but just kind of regular stuff, residential sales, things like that. But I was able to immerse myself in the world of real estate. And I did that for about 4 years. And most of the time, though, I was always focused on investing, even though my income that was paying my bills was through commissions, through sales. And I stuck with it long enough to get what I needed out of it. And then I jumped back into the tech world because I didn't want to be working on commission. I wanted to be growing my portfolio as an investor. And I've kept my broker's license ever since, although I currently don't directly represent clients. I actually frequently work through other brokers, and other brokers will bring me their deals, and I'm just their client. I just happen to have a broker's license as well. And then I just started jumping in. My first deal was a deal that was related to my own home, and I did an interesting development deal on it where I basically doubled its value by working with some neighbors and cooperating on something that literally doubled its value quickly. And I took the money from that first deal, if you want to call it that, which again was actually my first home, and actually took a step backwards in terms of home. In other words, instead of rolling it up into a fancy home, I took the delayed gratification route, and I said, okay, well, I'm gonna get a fancy home later, and for right now, I'm gonna start investing. So I got just an average home that was actually a step down from my prior one, but I threw all the money that I made on that first deal into a 29-unit apartment complex. So I jumped in pretty quick. I learned a lot of things. I still have that property. I don't know if I would have bought it at knowing what I know now, but at the same time, I paid my tuition, so to speak, and by owning it, and then that just started the ball rolling. For the past, I'd say 14 years, I've been progressively rolling my profits forward. So my full-time job, I'm now a full-time real estate investor, but for most of that time I was also working in tech, and I would actually roll my profits forward, all my income from the real estate forward, look for opportunities to leverage, do cash out refis, use solo 401ks, all that kind of stuff, whatever I could to build my portfolio and make it bigger and bigger and snowball.
Awesome. I think your path and my path are so similar, that working in technology and things like that, and always reinvesting your profits into your own portfolio and growing it bigger and better. That's exactly the path I took. And from your story as well, Scott, I think what's evident also is that you're always connected with the market. The part that you shared where you had the brokerage role in real estate also is very important, where I think you're always connecting with different brokers, networking and things like that. You're always connected to the market, so that when the deals are hitting the market, or in fact, even if someone is having a pocket listing, as we call it, they will bring it to you knowing, hey, Scott, because they know that you purchase investment properties. So if something is coming across their desk, even, for them, it's a win-win that you can buy right off the table, rather than for them to go create all this, beautiful investment packages and, do all the showings and things like that. There's nothing like, having a ready buyer that they know that he will purchase these. Would you agree?
Absolutely, and it's interesting you say that, because that literally happened 2 weeks ago. I currently have a property under contract, a small multifamily, a 10-unit, and it came to me from a broker. They were going to list it, but they knew me I'd worked with him several times before, knew I was a person of my word. I delivered. I didn't renegotiate after making a deal, all that kind of stuff. They said, hey, you can have first crack at it before this. And he told me what the price was, what the seller wanted. And I came in, made it really easy for him. And we're moving ahead on it right now before it ever hit the market. So
that's awesome. That's awesome. That's just so coincidental, right?
Yeah. And actually the other property I'm working on right now, which we're still somewhat in negotiations because there's a bank involved, but as far as with the seller, we've already agreed, and that's on a retail strip center. And that one was completely off market, but it was through a broker, and but they were having issues with making their payments and things like that, and they were kind of looking for a way out. And so this broker came to me, same kind of thing, but again, they knew my track record. It wasn't just that they're randomly dialing people. They came to me because they knew I could perform.
Sure. And one big piece from experience that we all know, Scott, into this is that we have those lender relationships that are so key to making these things happen, is that lenders will bend over their back to do some creative financing and make the deal work for you, knowing your track record. I mean, from my prior experience into multifamily and a lot of other deals, we've created some very creative structures where, we are coming down with a lower down payment upfront, but through, creative NOI strategies, we are basically paying a whole lot more towards our loan proceeds that's getting back to equity and things like that. So those are the creative structures that you can come up with once you have a lender that believes in your track record. Would you agree, Scott, there?
Absolutely. And that's a good point. That's a really important other side to the equation, because once you get the deal, you got to finance it or whatever you're going to do.
Right.
And it's so important also on your cash on cash return as well as your long-term return. If you can make it creative, if you can maximize your leverage, if that's appropriate, and if you have something you need a little flexibility on, say, some rehab or construction, or interest only for a little bit, or whatever, when you have the track record and have the relationship, what's advertised on the website is not necessarily the only option that is really out there.
Absolutely. And to add to that, Scott, is that once you work with local banks or some of the portfolio banks, as we call it, I think the world of financing is so much open that it's very interesting that lenders understand that investors are such key clients to them, that they are always looking for very worthy investors who have a very good experience and track record, that they know that if they make these loans, there are prudent investors like you and I, where they know that they can rely on them, on the operators like us, and they know for sure that their returns will be guaranteed. And more importantly, the investor will do the right things at every point of the way. Would that be a correct statement, Scott, there?
Absolutely. And what it boils down to is a bank or a credit union is generally a very conservative organization, and essentially they're looking for ways that they can protect themselves, which is fair. They're putting a lot of money into it, and they're looking a way to protect their principal to start, and then to protect hopefully their income stream after that, just like a passive investor in a syndication in some ways. But the difference is that they have several different levers that they can pull to say, okay, where do we think there's risk and where do we think there isn't risk, and where can they give and take? And if part of the risk of the sponsor or the manager or the owner, the person who's buying the deal and getting the financing, if that reduces risk, then they can be willing to take a little bit more risk in some other areas to counterbalance that.
Absolutely.
Part of the benefits of having a good track record.
Right. And as you said earlier, Scott, about the stock market versus real estate and things like that, right? So leverage, for example, is such a huge part of real estate, that you can own a whole lot more. That, as we all know, like viewers and listeners of the podcast who may be listening, that you can pay maybe 15, 20, 25% down and still own a bigger asset. As we all know, which is basically not possible in a stock market world. And to come back to your, the financing piece that we were speaking about, that the same real estate becomes such a good collateral that these banks have a good appetite that, hey, yes, we want to lend. We know the operator is good. We know the asset very well. Here's the money, and that's where your experience and your track record comes in. The more deals you do, the easier it gets, basically.
Yeah, and of course, not only the more deals, but the more successful deals.
Sure,
in other words,
sure.
If you can, which I know is what you meant, but
right.
In other words, if you can show that track record of, hey, had this deal and this deal and this deal and this deal, and every single one of them is doing well or sold off at a profit or whatever. And also to your point about how the power of leverage, the biggest aspect is that when you put your 20% down, that's great, but if there's appreciation, if there isn't always appreciation, but if there is appreciation, certainly there's been a lot of appreciation recently, but if there is appreciation, it's not on that 20%, it's on the 100%. So, that appreciation is multiplied many ways.
We like that. We like that.
Yeah.
So that brings into buy and hold here, Scott, is that why you like buy and hold strategy? Why not maybe perhaps flips or wholesaling and things like that? I know you are a big fan of buying and holding it for the long term for cash flow and things like that. Why is that your strategy only?
Sure. So I have done a couple of flips, but it was mostly just opportunistic, and it was more that the property would not have made sense as a rental, but it made sense as a flip. Nonetheless, exactly what you said. I'm a buy and hold guy, and they were just kind of tried it for fun, actually, in a way. But buy and hold, to me, it's a longer term game. You don't get that rush of $30,000 profit on a little home that you sold right off the bat. But at the same time, I'm in the process. I still consider myself to be in the process of building scale, to build repeatable, consistent income that I can rely on, and that I can rely on other people, meaning property managers, contractors, attorneys, all the people I work with on my team, to help me develop that income and that net worth. Whereas with flipping, now some people have very large flipping operations and they've essentially created a business, and they're also leveraging other people. I get that. But at the same time, it's more of a job, and not that job is bad or anything like that, but you're getting paid more directly for your time in flipping. As a generalization, you're getting, you put time in. A lot of people would do it, swing the hammers themselves, or at least GPing it themselves, things like that. And it's not scalable. It's why I have property managers, because if I was out there taking care of all the residential properties I have myself and talking to the tenants directly, I'd have a limit on the number of properties I would be able to own, purely based on time, not based on capability or anything like that, but purely based on time. And it's a similar thing where, yes, I'm willing to do the delayed gratification, where when I first buy a property, maybe I'm only making $100 a door a month or something like that. And $100, you buy yourself a 10 unit and you get 100. If you get $100 nowadays, it can be hard to do that in some markets. But let's say you make $50 a door, in a nicer market, and to start. But in 10 years, you're riding the inflation train. I think you've paid down the mortgage, all this kind of stuff, and when you start adding one on top of the other, then those hundreds turns into thousands, and thousands turns into 10,000. So, and it just snowballs.
Couldn't agree more there, Scott. I mean, I'm in a similar boat where, owning a couple of hundred rentals between, single family, multi-family, things like that. That's exactly how we stacked up. And as you rightfully described, that, the more units you do, the better job you get at it. And you want to be in that realm of passivity, as I call it, is that the more you do it, you want that consistent, reliable income, as you rightfully said there, is that a little vacancy later on doesn't rock the boat. It's really that consistency. I mean, for that matter, as we all know, that what a flipper might be getting profit on one deal doing months of work, we probably make that money just in a regular monthly cash flow without even turning any levers right now. Would you agree?
Yeah, exactly. And that's not on day one, and that's the difference,
Sure, absolutely.
especially if you're kind of, building yourself up, meaning, rolling your profits forward. But,
Sure,
on day one, or let's say day 90 maybe, or day 180 or whatever
sure,
for a
sure,
flipper,
sure.
they get that rush, they get
Right.
that big paycheck, but then they don't have anything else coming in, and then they got to start all over again.
Right, right, right.
And,
You become a deal hunter, and as you rightfully said, that it just pretty much becomes a job. Whereas with buy and hold strategy, the more you do it, I mean, the lesser you are doing on a ongoing basis as far as deal flow. And we do have to manage the property management aspects of things, and so there are some considerations towards that. But usually, if you have bought good cash flowing rentals and you manage them, even the property management aspects tend to lessen out over time, because the properties mature. You tend to have good paying residents that are also a reflection of a good property management that you have. And your batting averages improve is what I'm getting at. And that's kind of the mantra, that to have greater cash flow. So here, Scott, I know you are an intentional guy for buy and hold and doing real estate investments. May I ask, like, how did that inspiration come about? That being intentional, having that vision that you develop, how did that come about?
Sure. Yeah. Well, building on the earlier idea that I mentioned of real estate seemed to be a good way of developing both continuous semi-passive. It's not ever really passive as an owner, but not swinging a hammer kind of income,
Sure.
and then also net worth. I then, to answer your question, I then started looking at ways of, okay, how can I apply this to my life? And some of the best advice that I've ever received was very simple, but it was very, at least to me, it was very meaningful. And it was to take what's called a deathbed perspective.
Mm-hmm.
And what that means is basically to imagine myself on a deathbed sometime in the distant future, and to look back and say, what is it that I wish I had done in life? What is it that was really important and valuable that I did do? And what is it that at this real point right now, and between now and that deathbed time, that is the gap? In other words, what is it that I still want to do? What are the big things that
Sure.
are important to me? What will I look back on in my life with a smile on my face instead
Sure.
of regret in my mind? And so I started thinking about it very specifically of how to do that. And one of the things that I did was I looked at the way that some people give a big picture view, and I created what's called a vision board. And I
Interesting.
did it with
Mm-hmm.
my wife, and we did that just before we started actually getting back active into real estate investing. That was about 15 years ago or so. And in our case, there are different ones that are done in different ways, but the way we did it was literally have this big sheet of thick paper, and we took pictures that represented things that were important to us, and we compartmentalized them, or categorized, would probably be a better word, into different sections on the board. And we hung that in our office every day. It was right in front of us, and it was a reminder. I personally like the visual approach, because you can see it, and it's a little more visceral. You can it has a little more feeling to it than just looking at words, that just list a bunch of goals or something like that. And so we hung that, and then started to think about, okay, what are the things we need to do to achieve that vision that is on that board, with every picture there representing something. And it had to do around family, around where we wanted to live, around the house we wanted, around the hobbies we had, around where we wanted to travel, around all this kinds of stuff. And it was all there on the board. And we still have that board. We've actually
I
updated
see.
it recently.
I see.
And
Sorry, go ahead. Mm-hmm.
Yep. And then the important thing, though, is to make it something that is tangible on a daily basis
Mm-hmm.
and not just a poster that you start forgetting about.
Mm-hmm.
So what we've done, and I would say, depending upon how busy we are, you know, we're I wouldn't say we're 100% on doing it every day, but
Mm-hmm.
we're very consistent about what I'm about to
Sure,
say.
sure.
Is I actually created a form, basically a one-page sheet of paper that that then puts it into words, goals,
Mm-hmm.
and the main goals, and then some sub goals under them, and then it says, and then there's a column that says, what am I going to do today for that goal?
Mm-hmm.
And at the end of the day, I grade myself. And there are three small columns on the right, and it says, and it's basically, it says no, partial, and yes. And that means no, I didn't do what I said I was going to do that day.
Mm-hmm.
Partial means I did a little bit, but not completely. And then yes means I did it. And I don't do every single goal every single day. That's certainly not the case. And, you know, there are
Sure.
blanks on that sheet of paper every day intentionally. You know, I don't work on every goal every day,
Mm-hmm.
but it's a very specific reminder of what's important to me and making sure that I'm making active progress on everything. And then also my wife and I have a weekly meeting. That's on a daily basis. And that ties back to a weekly Monday morning meeting where we both get together and we plot out our week. And so we have kind of like a little higher level and plot out our week. And again, it all relates back to goals as well as what's going on. So, and that we found that, you know, life will pull you around. Everything from bills to what other people want is important. So always making time for what you want to be important a year from now will pay big dividends. It might not seem like you're making big progress today, but if you make little progress on your big goals every day or every week, then at the end of the year and 2 years, oh my gosh, wow, you've actually done things that were really important that if you hadn't made those baby steps at first, you wouldn't even, you know, be there in a couple of years.
That's awesome. That's awesome. Thank you for such a detailed answer. There are several things to unpack from that, Scott, is that you listed your vision goals, starting with pictures of all your wishes, wants, and things like that. You worked collaboratively with your wife to come up with a collective picture of, the entire vision of long-term things that you want to do over life. So your family and your wife was definitely an inclusive part of this all exercise. And then you have a sort of long-term, medium-term goals that are broken down into actionable plans, like perhaps monthly, weekly, and on a daily basis. And what's interesting for me to also learn is that you track your activities based on those goals on a daily basis. So it sounds like you almost have a journal where you have several pages that you can go back. Okay, what I was doing maybe 30 days back, that was how it was correlated to my goals, which is, and what's interesting is that as you fast forward several months or so, it almost makes up a story, is that whether you were on track or off track and things of that nature, which is very, very powerful actually. That, as you rightfully said, that there are things in life, whether it's social media or the other immediate problem or a ringing phone and things like that, those emergencies that always, pull us in all kinds of directions. But having that vision board right in front of your office and a visual picture is a constant reminder that where you're going, it's almost a sort of a lighthouse or a guiding post of sorts, right?
Absolutely.
Awesome.
Yep, that's correct.
And this vision board, do you also keep it in your bedroom as well, Scott?
No, we just have it in our office because that's where we're up and awake. So
Sure. Okay. Awesome. And how it has changed your life? Meaning, I know a lot of people they are making like half-baked efforts and things like that, only to whittle away and things kind of fall by the wayside. Could you maybe give us some tangible examples of how you were consistent and how your vision board kept drawing you back and kept you on track, and what you are able to achieve as part of this exercise?
Sure. I give you an example that, for instance, was last year. So we've always wanted to live on an island called Whidbey Island, which is where I'm currently living. And when we moved to Seattle about 20 years ago, we fell in love with the place. But the island doesn't have much economy. It doesn't have, it certainly wasn't supporting the kinds of high tech jobs that we were part of, both me and my wife. And so we had a plan. Whidbey Island's there, having a certain kind of home on the waterfront with a certain kind of view. There's a picture of that there, the whole deal. And then, so what we did was we started the process of, for instance, looking for land. And I just built that home. That's effectively, I mean, it's not a picture of the home because it didn't exist yet, but the idea of the home that was on that vision board, we built that last year. And 7 years ago, we bought the land for it, even though we didn't even live on the island yet. But it's like we knew we were going to do it.
That's awesome.
We were going to move there. And then 4 years ago, we moved to the island and said, okay, well, next step is move there. So we're going to move there. And I found a job that I could work remotely. So I actually specifically was looking for a job at a high tech company where 4 out of 5 days I could work from my home office, specifically again with the goal of living on that island and moving into that land, and then after a few years we got the process started on our home, and we built that last year, and now all that one particular little corner of our vision board is all accomplished.
That's awesome. That's awesome. It is so powerful, actually. So, Scott, you own, assets in several different sectors. Single family, multifamily. You have medical offices, retail. You've done some land structuring, land deals as well. Describe why you have done. I mean, it's an unbelievable effort on your part that you are opportunistic in very different areas. I think the challenge comes in is that not a lot of investors are always, educated enough to jump on those deals. And I'm impressed to see that you have such a varied class of, investments that you have made. Could you maybe share some tidbits about it, that why you kind of branched into all these different aspects, and what was appealing about one sector versus the other? The leasing structure, as we all know, is quite different, and things like that. Things are evaluated differently based on a different sector. Could you maybe share some tidbits about that?
Sure. Yeah. In most cases, it's not that I'm just in one class and there's this one class, one asset class that meets my goals. So I've always been open to the idea of it not just being single family or not just being multifamily or something like that.
Right.
And really, it became a matter of learning what are the key parts that I need to look at when I'm looking at especially office and retail, because that is a different animal than multifamily, which is kind of like single family on steroids. And believe me, I'm obviously well, I'm I'm generalizing it a very, there's a lot of
right. But I get the whole idea that.
But it is
totally a different animal in terms of how you would look at office versus retail versus like a single or a multi-family residential side of things. So go ahead with your thought.
Yeah, so I started a combination of things, of educating myself, literally starting reading, and then meeting people who actually had experience in office and retail. Even went to training seminars on it where I could find it. There actually, frankly, isn't much on it. Most of it's about multifamily, but that's understandable because there's a lot of multifamily opportunities. But there was some, and really kind of like my first multifamily, which was a 29 unit, and I just kind of jumped in, learned a lot, and both I'd say all of it good, meaning even the bad was good because I learned from it.
Sure.
But the initial ones, I just made sure that when I was looking at office or retail, I was really looking at a couple of different factors that are key for those that are not as key for multifamily, or
Sure.
if I was doing some singles. So things such as looking at location and traffic count and parking and access and signage and what kind of tenant would be there next if this tenant left, which you really don't look, you look at in multifamily, you think of the next tenant, but it's more at a demographic level.
Sure,
Whereas
sure.
in office and retail, you've got to think what business almost by name would be interested to move here. And if it became vacant, and it's a whole different thought process because it's very specific. You got to
absolutely, and you're open to the market as to what's happening around you, as you rightfully said, like the traffic counts, what probably is some gentrification that may be around the blocks and things like that. So you're open to competition as well. A lot of different forces. How about medical? Like, how did that medical space come about?
Yeah, well, seeing the opportunity in that, that you've probably frequently heard about, the general population getting older, which generally requires more medical facilities. Also, there's separate from that, but you could say in some ways related, but it is somewhat separate as well, is there's a move of many large-scale providers. So it might be an HMO, it may be a hospital, something like that. There's a move to actually distributing their offices. In other words, you still have the central areas where there are a lot of doctors and a lot of offices and a lot of different specialties. That still exists, and it's not going away at the moment. But there also are a lot of facilities that are becoming distributed, and they're moving their services out to the people that they're serving. And so small medical office is becoming a bigger opportunity from two perspectives. Number one, the increasing number of people who need the services, and number two, there is an increasing opportunity for locations that are beyond what was normally considered to be the central hub around a big complex or something like that. So I started looking for those opportunities of what, where was their demand, where was there a need, where were there small groups of doctors who had their space completely filled, and it looked like there needed to be some more. In other words, it was creating a small hub, not a major hub, that kind of thing. And and started getting into it. And for the most part, it's been really good. Just like anything with office and retail, the biggest thing you have to be prepared for is the potential, unless you're in some great downtown location or something, but the potential for a longer vacancy than you might be used to if you're used to residential.
Sure.
Yeah, so because you've got to find the right fit, and if a current tenant who might have a 5-year lease, I have one of my tenants has a 10-year lease that I just got, so it's great because they're very long-term triple net leases. And for those who are listening who don't know what triple net is, basically that's where the tenant is actually responsible for the maintenance and paying things like property taxes and insurance and things like that. Sure. And so it's fairly low touch, but then if they leave, it can be very high touch because you got to really beat the bushes to find somebody who happens to need a new medical office at that time in that location. And that's not everybody.
So right. And for our listeners, there's something called Tenant Improvement Allowance, TIA as the term used in the commercial world, which is basically a landlord allowance for tenant to come in, and landlord will basically reimburse some of that money that what a tenant might be doing, and goes back to the story of what Scott is mentioning, that finding similar tenants so that you can have perhaps lesser improvements to be done from a turnover to turnover. So for example, someone is going from a medical facility, medical doctors, to perhaps just a simple operation like a dental operation, perhaps, which is similar kind, but not like, going from a medical to something like completely different, like a chiropractor or something like that, which will require a lot of reconfiguration, which brings in a lot of expense on the landlord's part. So with that tenant improvement allowance in mind, Scott, have you had to do some of that as well in your office spaces as well?
I have, and it's depended. And what I mean by it depends is in some cases, I've provided what I consider to be a good baseline.
Hmm.
So I've actually improved things that are perhaps more infrastructure related. So one building, for instance, we put in an all new HVAC system,
Sure.
which was good because it was getting end of life. It's my building, but it also helped them. Reduces maintenance overall, reduces expenses, things like that. I repainted the exterior again, which doesn't actually change the interior,
Mhm.
but I did improve. I improved the parking lot, and I did all those kinds of things that were more external infrastructure related, and
Mhm.
then they were responsible for whatever they wanted on the inside. So that was one model. And
Mhm.
then another model I did was I just gave them basically a good baseline of good flooring, meaning good commercial carpeting and in good condition, but they didn't pay quite as much rent as if I had made a big contribution toward the TIs, or the tenant improvements. That was
Mhm.
another model I did. And then another time, this one was I found was interesting. The the tenant was flexible, or they weren't sure how long they wanted to be in the building.
Mhm.
And what I did was I used tenant improvements as an incentive. And I
Mhm.
said, so I said 5 years is kind of a standard minimum. It can be certainly less. It doesn't have to be, but 5 years is frequently happens as
Sure.
a lease. And I said, for every year above 5 years, I'll give you X amount toward your tenant improvements.
Oh.
So
Mhm.
so I gave them an incentive, and the benefit to me was that I knew assuming they didn't get abducted by aliens or something,
Sure.
they
Sure.
that for I had a longer period of time for
Right.
them to be there. And so they actually ended up signing a 10-year lease. And I put out a little bit more funds up front, but then I had more surety of having a good tenant there for a longer period of time, and not having to look for another follow-on tenant if they were to leave after the lease.
That's awesome. That's awesome. Thank you for sharing that interesting story there. So, Scott, what is your purchasing criteria like? So, when you buy these different assets and things like that, what sort of metrics you're looking for? I'm sure it's slightly nuanced based on like which sector you're looking at. But could you give us a rundown on what sort of opportunities numbers you look for in these?
Sure. But before I hop on numbers, if you don't mind, I'll kind of start. My big criteria are two things.
Hmm.
One of them is not numerical, but it's more market based. So
Hmm.
I'm generally a secondary and really tertiary market kind of buyer, meaning, and for anyone who hasn't heard those terms, it's basically smaller towns kind of thing,
Sure.
but not too small. I mean, I do have a minimum population and also a minimum that I'm looking for in terms of population growth and things like that.
Hmm.
So so I'm starting on local economic drivers, local population, what's in the pipeline, what's the potential competition, things like that. So things that are real high level, but in some cases I have turned down really what on paper might look like really good deals, but I didn't see the long range prospects there being
Sure,
necessarily
the
being.
market forecast just doesn't jive into vibrancy or the future sort of vibrancy of the market and hence the deal in general, basically.
Exactly. And the
Awesome.
reason that they were such a good deal was partly because of that.
Sure, sure.
It's
I know,
like,
I know.
for somebody who's willing to take the risk
Right.
of buying it, they could do well. But at the
We've
same
seen
time,
all those 12 cap and 14 cap deals, right?
right? Exactly. Yeah. Yeah. Those are. Yeah. If you find any of those, send them my way, please.
Right,
But
right, right. So, what about some cash on cash numbers and things of that nature?
yeah, so that I mean, it's kind of funny because it has changed recently, and the only reason it's changed is because the market is a great time to be a seller, or it's a tougher time to be a buyer. You still can be a buyer, but it is a tougher time. But as far as cash on cash, I'm generally generally looking for at least I'm generally looking for at least 10% to start, and not IRR, not internal rate of return, but as far as cash on cash, I'm usually looking for at least, at least an 8 cap, kind of property. And then depending upon the financing that I can get, I'm looking for at least 10% cash on cash. It's hard to find those nowadays. I'm finding them, but they're it's getting harder and harder. It used to be a lot easier as for everybody 5, 6, 7 years ago. But and then my IRR, that's completely situation dependent. Is it a value add? Is there an opportunity to add a lot of value? Most of the ones that I'm buying, I'll then be able to build on that cash on cash return, and I'm looking for some kind of opportunity. I don't buy places that are boarded up with nobody in them. Some people do, and that's great, and they have the opportunity to actually make they take a large risk, but they have an opportunity to make a lot of money. I take more of a risk-adjusted return approach, and I generally buy occupied properties that are under market rents and have some deferred maintenance.
Right. No, and as you referred there, Scott, is the vacants, the boarded up or like significantly low occupancy, prospect that come with such a huge, risk in terms of compliance, all kinds of permits that may be needed, and it just throws in sort of that whole uncertainty in the project, which I think is a big problem, because you could get into a deal and not realize what sort of improvements are needed to bring it. And especially if something is vacant, I know around here that if something is vacant that you try to improve it, they will the county will require you to bring it up to the modern standards, where you're adding sprinklers and fire resistant barriers and things like that. And those are the normally quite a bit unanticipated costs that you do not foresee going in. And that's where I think a good deal can become a real problematic, a deal to pull through, basically. And you rightfully said that if it's slightly unimproved, whether it's management or whether it's deferred maintenance and things like that, we like those deals, so that the upside is guaranteed through concrete actionable plan that you can implement. So very well said there, Scott. I know, Scott, we take advice, we surround with a lot of good people all the time. What were sort of your mentors or good advice that you received over time, over the years?
Yeah, so initially it would start out with people that I would get to know, network with at local RIA and very meetups, things like that. And eventually over time, as I got to know people more, and the other way around, as people got to know me more, I really honed in on the ones that were of the most value to me. Now that I'm further away now from a metro area, from the Seattle metro. So I used to go to those kind of meetings more than I do now that I live on an island, but I still try to get to those. But I'm very selective, and some of them I do go to that still have lots of beginners. I'm still interested to meet folks who are new, and it's always interested to talk new concepts and stuff like that. And then on the other hand, I've honed down to just a select few that are really very, in some cases, very experienced individuals, almost like the equivalent of a mastermind group, essentially. Sure. One of them, my favorite one, for instance, and we meet on a periodic basis, is it's not a meetup, it's not public, nobody knows about it, you got to be invited, that kind of thing. Mm-hmm. And the only way you get invited is, you have a track record. And
knowing each other. Absolutely.
Yeah, and I love that. There's no speaker, there's no agenda. We literally just go around the table and talk about what we're doing. And I learn so much, and I think people learn from me as well. And it's very valuable. So it's I've done some, I've gone to some seminars and things like that, but and some of them have been very valuable, actually, especially when I was initially starting out. But now it's gotten more to people who are really doing it. and learning from them and them learning from me. It's a two-way street.
Sure. Thank you. I appreciate your time today, Scott. How can people find you and learn about what different things are happening within your company?
Sure. So two ways. You could go to my website, which is bonvolo.com. That's BON as in November, V as in Victor, OLO.com. Or you can reach me directly at Scott, SCOTT, at bonvolo.com. And either way, the one you'll learn a little about what we're doing and what we're working on, and the other one you can contact me directly.
That's awesome. Thank you for taking time, Scott. Listeners can gather more about Scott at his website, and you are such a truly an inspiring example of someone who has learned so much and, more importantly, done deals in various sectors, which is very uncommon to see that someone doing so many deals especially in an early stage of career. So I want to applaud and congratulate you for that. So it's been a pleasure having you, Scott.
Likewise.
Sure. And listeners can also find a lot of good, valuable articles, statistics at premiumcashflow.com. We also have a good podcast where we share YouTube videos with experts like Scott, and a lot of other content is available on social media, whether it's Facebook closed groups or whether it's on SoundCloud and things like that. So please head out to, if you are interested in any investment opportunities that we may have, they are available for accredited investors only. Please drop us a line or sign up on the mailing list. There is a tab on the website called Invest With Us. With that, you can register yourself and learn more about the good opportunities and different sectors that we are working on. So it's been a pleasure having you, Scott. I look forward to exchanging more notes with you, and always love the pleasure of the company with experienced guests like you. So thank you for all your advice and adding value to all our guests today.
Oh, thank you very much, Sakar.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.